is Bryan Shaffer. I'm one of the 8 partners here at George Smith Partners, and we're excited about our guests today. We have a great lineup. What we decided to do on the CMBS side is have a borrower, 2 lenders, and a workout specialist, because everybody knows we're seeing some workouts today. So our goal is to really help our borrowers understand CMBS, understand what options are out there, and to let our guests really share their opinions and views of what's happening in the market. I view CMBS as one of the most important non-recourse options that's out there in the market today, because even though some borrowers don't like it, it's the biggest source of non-recourse lending. So when it's gone or when it's not active, every other lender doesn't want to do recourse. So when clients ask me about non-recourse today because the CMBS market's just reopening, I'm telling them, you're probably going to have to sign some recourse, because that's what we're seeing in the marketplace today. We haven't seen lenders willing to do non-recourse loans. We're hearing talk that in the next month, some of the multifamily guys are going to come back, and you obviously have agency doing non-recourse, but outside of that, it's very hard to find. So I think today's discussions are really important. It's been a crazy week. The Fed, when they testified this week to the Senate, talked about CMBS. It's the first time I've ever heard that. It's usually bigger batches of money, not CMBS, or at least real estate CMBS. And this week they were talking about it. So we're in the news, and I think it's a really key topic. Also yesterday, there was a CLO offering that went through, so the market is starting to reopen a little bit, and we're seeing some fresh air. So I'm excited about the market, and I wanted to introduce my co-host, Jarod King. He joined our firm about 3 months ago. He was on the CMBS side, so he's perfect for this role. David Pascale is not going to make it. He had some surgery on his arm, on his shoulder, and he's unfortunately not here, but he'll be here soon, and he's great on this topic as well. So Jarod, what's going on in the CMBS market? What is the volume? I mean, how does CMBS relate to the overall market?
Yeah, thanks, Bryan. So just to give a little more scope to the size and the mass of commercial mortgage-backed securities, in 2019 we saw about 98 billion of new CMBS issuance. Looking back into January of this year, I think at that point most experts were expecting to see about a 5% increase year over year. To date, there's been 25.6 billion of new CMBS loans issued, most of that prior to March, obviously. And then just the total market, there's about a $500 billion of CMBS debt outstanding, which places CMBS as the 3rd largest vehicle behind banks and the GSEs. So, 25 years ago, CMBS kind of emerged from scratch, and it's provided an additional funding source for commercial owners, specifically, like you said, of non-recourse, higher leverage, but it's arguably also helped lower the overall cost of borrowing. And I think it really has made commercial real estate far more liquid, which is why having these markets running smoothly is imperative to the overall health of the debt markets for borrowers and lenders alike.
Yeah, that's great. Thank you so much. So today we've got Matt Lefkowitz, who's with Crown Properties. We have Chris LaBianca from UBS. Sorry about that, Chris. Mark Fluent from Deutsche Bank, and Tammy Goldfisher. I apologize. I keep doing that because of the James Bond movie, and she's correcting me now. And why I keep doing that. I promise no more today to do that. Those of you that don't know George Smith, we basically find debt and equity for developers and owners of properties. And Matt's one of our clients, and we have several clients listening today. And we really want you and encourage you to have questions. So if you have any questions, just open the chat box and send us the questions, and we'll try and get to them during the seminar. So let's start with Matt. Matt, why don't you tell us about yourself? And the other thing I want to ask you, and I want to ask all the panelists, is what did you learn most about yourself during this period of being confined at home?
All right. Thanks, Bryan. Good morning, everyone. So Crown Properties is a New York-based family office. We own, operate roughly 6 million square feet of office and retail throughout the country, and another 2,500 apartments. We utilize all types of financing, bank, Freddie, Fannie, as well as CMBS. And I would say, throughout this whole pandemic, I've learned that multitasking has a whole new definition, if you will. So work on one hand, school on the other, cleaning and cooking. But it's been great to spend time with family and obviously, continue working from home. So pleased to be here and thank you.
Thanks, Matt. Tammy, you want to give a little background on yourself real quickly? I know Bryan introduced you and what has being trapped at home revealed to you.
Good afternoon, everyone. I'd like to say happy Memorial Day weekend. And I think being trapped at home is just really focused and high relief to be grateful, grateful for having the opportunity to take care of family, take care of yourself, but then also to balance that with serving other folks when you can. I think that's been a great message that I've been able to share with my kids as well. So I think having some expertise in the CMBS field after being in it for 25 years and co-founding the Henley group, we've been working on these type of CMBS transactions with special servicers for over a decade. And so while this COVID is unique and borrower blameless, we've been using and understanding this playbook that the services use for a long time. I hope today I can share some of that to relieve some anxiety for some of the callers.
Chris, how about yourself? Are you still in New Jersey or are you on your way for Memorial Day?
I am in New Jersey, but as soon as we wrap up here, I'll be headed to the beach. It's actually nice weather. Yeah, I'm with UBS, been with UBS since 2013. As Jarod said, CMBS has been around 25 years, and I got into it sort of at the beginning when I was with Chase, actually the old chemical bank, and we started a CMBS group back in the early 90s. So been doing it a long time, spent most of the go-go years in the 2000s at B of A doing the same thing. The one thing I would say since I've been home, I've gotten 3 hours of my day back, not having to commute back and forth to Manhattan. So I've gotten in touch with my inner musician. I called up my old guitar player in Portland and we started writing songs again. So, maybe there's a plan B if CMBS doesn't work out.
Awesome. Mark, it looks like you're at your office. You're here in LA. You want to give some insights, self-discovery during this crisis?
Sure. I'm here because I think the good news is the Department of Transportation they decided to utilize this time when nobody's on the road to fix a lot of the roads in LA, and they're saw cutting the concrete in front of my house today. So this is the quiet place I could get. But yeah, we're just we have a new puppy at our house, so it's good to spend time with him. And the kids are working from home, and we're cooking and going for hikes and the same stuff I think a lot of people are doing, and anxious for things to start to get back to normal.
No, that's great. So why don't we get started and
Oh,
jump
by the way,
into—
I work at Deutsche Bank, sorry.
You did? George Smith. So, no, that's great. So why don't we jump into the questions? I think the first thing we wanted to talk about is the impact of this crisis on hotels, retail, office, and multifamily. And I thought, Matt, you're the best person to start with that topic and tell us what you're seeing out there. And not only how you've been impacted, but how your friends and family have been impacted as well.
Yeah, so look, I can't speak to hotel or industrial, but I can tell you on the retail side, we've clearly seen some issues with, if you want to call it high street retail in Manhattan, where there's just been zero rent payment. Those stores are unable to open and have been mandated to shut. The same goes for gyms and fitness studios, et cetera, restaurants. Grocery anchored shopping centers have done a bit better. We've seen collections there roughly in the 75% range. And across the office portfolio, both core and value add suburban, we've seen collections, right around 90%. So off a little bit, but not terrible. And on the multifamily side, things have been a bit better. For April and May, we've seen collections of roughly 97%. You obviously have a few bad apples that you've had historically, and maybe a couple additional people that need some help. But we're working with those people to figure out payment plans and try and be as compassionate as possible while moving forward with business and collecting rent. Because frankly, the CMBS servicers and the regional banks and the other lenders out there are not doing much with regards to forgiving debt or making any type of relief available. There is some limited, but it's far and few between as far as we're seeing. So luckily we haven't had to use that. We've been in a very good spot, but there are certainly some struggles, and depending upon how much longer this goes, we think that pain could get a bit worse.
Chris, what's been your kind of short and long-term view, the impact, and maybe touch on some of the asset classes that Matt didn't elaborate on?
Yeah, sure. I think, what I found it's become pretty hard to generalize. The impacts have been fairly uneven. Certainly in the short term, from a credit perspective, there's been a reduction of credit, right? But that's not equally distributed across the board. There's certainly plenty of credit available for multifamilies from the agencies. But if you're trying to get hotel loans, I think most capital sources are either not quoting or very cautiously or selectively quoting. Same thing for retail, right? You can say that, retail's been impacted, although, to get a Walgreens or a CVS or a grocery anchored shopping center done today, you can get it done. But to try and get a strip or a big box or a mall done is a whole nother question, right? So it's been uneven. It's certainly been uneven, I think, too, from a geographical perspective and from a size perspective, right? The smaller deals, I think, get more attention. The larger deals are really hard, particularly from a CMBS standpoint, because, when you're taking down something, that's, let's say 100 to 150 million, you're probably not going to be able to, get that all done with one securitization. And it's really hard to put together a forward calendar today. So, I think you're going to see some big changes on that side with with respect to those loan sizes. You'll probably see some co-originations or guys teaming up. So, people aren't sitting with inventory for a longer period of time.
No, that's great. Mark, what do you think? Do you agree with that?
Yeah, I do agree. We're just now entertaining the concept of getting our toe back in the water and starting to lend. And we're one of the agreements we've made with our internal credit people is that we won't inventory these loans for extreme periods of time. So we're going to partner with folks like Chris and other banks and other issuers and try to have the least amount of exposure to fluctuations in the market as possible. Back to the shopping centers and hotels, I think it's probably going to be a while before the liquidity will come back into the hotel lending side. The thing about CMBS, it's always kind of been backward looking and based on historical cash flows on properties. And I think it'll take a while before hotels in particular, less so for shopping centers where they're leased up, and assuming most of their tenants come back, they should be able to rebound faster than hotels. But I think that for the hotels to ramp back up will take time, and for them to get the T6, T12, whatever the rating agencies are going to require to get those loans underwritten and rated, that may take a while. But yeah, I agree with Chris.
Tammy, what are you seeing? Are you seeing more hotel and retail clients, or are you seeing it across the board, every property type?
We are seeing hotels and retail predominantly. We have, pre-COVID retail that had some cracks in it, and we were starting to work on, some larger malls and centers that retail was already, downsliding. So that has continued. And then the hotels escalated exponentially, mostly due to COVID. So with the COVID influence, there's a lot of hotels that we're talking to, owners that have performed very well to date, but obviously their occupancy is way down and they don't know when that's going to be returned. So they're very concerned. They're trying to stay at the master servicer level when they can for a consent, but that works for about 90 days. And then, you know, they have to touch the next problem, which is, where do we go from here? My occupancy isn't back where we need it to be to pay debt service, but my forbearance has expired. So they're going to be spending some time, much longer than they hope to, dealing with, you know, possibly going into special servicing at that point. And nobody likes to be in the special servicing, but it is a place where you are when you need anything more than forbearance. Any major modification, you're going to head into special servicing. And, you know, 7% of all CMBS loans are in special servicing right now, which is a high number historically.
No, that's
Usually
great.
about 1 or 2%, right?
Excuse me?
It's usually about 1 or 2%.
Yeah, it has been, you know, the last time in 2000, after a Great Recession, 2008, 2009, it got up to almost 8% in certain sectors. But the velocity at which it's happened is the greatest difference from, you know, the prior cycle.
And do you see those special servicers accommodating at this point, or are they so overwhelmed that they're just trying to kick the can down the road like most other people at this point?
I don't think the call volume to both the masters and special is very high. You know, I've been on our firm has probably been on 200 plus calls with servicers. So they have tried to tap into any capacity they have within their shops, taking originators and other employees to kind of become asset managers. So they will be getting up the curve on that. And then they, you know, for the first 60 days almost, they were very careful in reading their PSAs, so they know what their responsibilities are and what their authorization level is. You know, like I said, master service are very little authorization. So they haven't been kicking the can, but I think due to the high influx, they're not going to reach out to you. And if you continue to pay your loan, you're certainly not going to hear from them.
Yeah, that's really interesting. Want to shift and talk about non-recourse financing a little bit, because I really think that's the main reason why people use CMBS, and also the flexibility in cash out that it can sometimes give properties. Matt, I know as a borrower, you've used CMBS a lot. What's your view of CMBS and why have you used it?
So look, I think there are deals that are great for CMBS. There are deals that are great for bank financing and balance sheet financing. We utilize both options. I will say that after, you know, we've spoken to every lender in our portfolio over the past 60 days. It is nearly impossible to get a decently leveraged loan on a full non-recourse basis from a bank lender at this point, unless you have an extraordinary balance sheet and a very large pre-existing relationship with them. They are being extremely cautious, and I'll tell you, we hear and we speak to those balance sheet lenders on a daily basis, even if there's nothing wrong. On the CMBS side, you know, we haven't heard from those guys. We've been performing, so there hasn't been an issue. But, you know, they're a little more standoffish, if you will. They just, I think they're so preoccupied by everything else that, you know, they don't necessarily want to see how you're doing if you're paying. But I think, look, we're lucky we did our last CMBS deal at the end of January, which is still in the market to be securitized, and got that one off. But I think you're and obviously Mark and Chris can speak to the point here, but pricing is probably a lot different than it was 60 days ago today. Leverage points are definitely a lot different. And look, it's hard enough as an owner for us to underwrite and project a deal going forward, given that you have credit tenants like Starbucks and Shopify and these other large public companies that are all asking for discounts, even though they're not entitled to them. So you could have a fully occupied building with great credit,
Yeah.
and those lease numbers may not project 12, 18, 24 months down the road, just given what's going on in the market. So I can only imagine from Mark and Chris's perspective, how they're going to underwrite these deals and project them for their committees.
It's difficult because I think on one hand you have a retail environment where there's getting less and less competitors, but I think consumers are going to be slow to return to their spending level. So I read that article where Starbucks is trying to go to all their landlords and get some type of concession, but.
So we have 2 Starbucks in our portfolio, and it wasn't an ask, can we get this? It was, we will require that you give us some level of. I don't know how that's going to work, but that was how the wording was.
So Tammy, is someone that, typically is getting involved when one of these CMBS deals has gone wrong, going forward as the market's starting to, see some life and kind of reverse engineering, what would be some of your advice to a borrower, thinking about doing a CMBS loan?
If you're thinking about doing a CMBS loan and you haven't experienced one to date, I think what you need to do is figure out the pros and cons, literally make a ledger, and what am I getting and what am I giving up? I think when things are going well, you can maximize dollar proceeds and leverage, and of course the no recourse on the CMBS side, and it's great. I think when there's a situation, whether it's a blip in the marketplace or COVID is more than a blip for sure, but you will see how difficult it is to talk to the servicers, to get in touch with the servicers, to negotiate anything with the servicers. So you really, in your loan agreements, if you end up going the CMBS route, really pay attention to the cash management sections, really pay attention to the carve-outs, in particular the recourse carve-out. We have a deal in the West Coast, a retail deal that the carve-out, if they don't comply with the cash management, which is, it's buried in the loan docs too, you have to go dig for these things, then that triggers a bad boy carve-out. That's one of the documents. That's not every document, and you obviously, everyone is working with attorneys to review those docs individually, but that was something we just came up with. So you really do have to figure out what you're getting, good times and bad, and be willing to make a choice, because you're not going to get everything with CMBS.
Mark, what do you think? Why would a borrower go? I mean, I know from our perspective as a broker, we bring people in, usually there's a clear-cut reason, whether it's cash out, whether it's a need for non-recourse, but what do you see as the main benefits of CMBS to a client?
Well, let's assume that you have a property that's of the quality that life insurance companies would be interested in lending on it in the first place. But like Tammy just highlighted, you can get a little more leverage. You can probably get some interest-only periods, or in instances of low leverage, you can get your entire loan for the whole duration interest-only. I think that the recourse is very compelling. Can you think of a worse time to be full recourse on a bunch of loans right now? I mean, you'd have to be feet coming out of pocket on everything if you're a recourse at this moment in time. So, but then for other properties that are lesser quality, I don't think that there's long-term fixed rate money available. I think Bryan, you said CMBS is the third largest provider of capital to commercial real estate. The first two that you mentioned are not fixed rate lenders. So if you want a fixed rate loan, you're pretty much in the life insurance and CMBS world. You could swap a bank loan, but like somebody else said, or Matt said, banks are being very selective. So for guys with B properties or folks that have like smaller assets that are maybe a smaller town, maybe the tenants roll during the term, insurance money is just not available.
Well, I would say certainly markets that are less appealing to banks, right? Banks want to only lend in their backyard or where they're very knowledgeable.
That's
CMBS
right.
is willing to go a little bit broader. I know Bryan and I did 2 deals down in St. Louis. I'm not from St. Louis. I have 2 properties or 3 properties there. But, for me to get comfortable with a local bank down there is going to be very tough. For me to get comfortable with Bryan and with UBS was much easier and a much, more streamlined process for, a New York owner, if you will.
Yeah,
And
I'd say
just,
that's
I know
one of the big.
Oh, go ahead, Chris.
That's one of the big advantages that gets overlooked sometimes, right? Is without CMBS in some of those tertiary markets, you're either at the mercy of a local bank or you're getting a hard money loan, right? There's no sort of in between, and CMBS provides a lot of liquidity there. Obviously, we've talked about the pluses and minuses on the portfolio and the CMBS side. We do both, but I always encourage guys to sort of have a healthy balance. You don't want to do all your loans recourse, obviously. And there are some properties that sort of set up for CMBS better. As Tammy mentioned, the difficulties of post-closing servicing issues. Well, if you have a single tenant property, that's a little bit different story, right? Than one that, maybe has 15 or 20 tenants and you're constantly having to go back to the servicer to get lease approvals. And so there are, ways to think about how you finance your portfolio overall that kind of utilizes the best of both worlds.
So I know that there has been a lot more activity in the secondary markets, and we've started to see some primary issuance. Chris, what do you kind of see as the timetable moving forward till we're kind of back to maybe where we were in terms of deals hitting the market? Do you see it, getting back to pre-COVID crisis levels, or where are we kind of at in that that stage of the pandemic?
Well, every time we have a crisis, it seems like they tell me the CMBS market is dead, right? 1998, 2001, 2008, here we go again, right? And it always seems to be a very resilient product because, as we've just discussed, it makes sense, right? It fills a void, so it finds a way. Pre-COVID, AAAs were sort of in the 90s, right? And things were great, and you heard where the projections were, for this year, and everybody thought it was going to be, tons of volume, and then everything just stopped. The first quarter actually was pretty good, around 25 billion, right? So, the last deal that got done was a CS deal where AAAs went, out to 139, and we were actually, next up. I remember coming into the office on that Monday, and I think it was the 16th, and we decided we can't do this deal. The investors are going home, and that was the day that we went home and haven't been back to the office since. So, the market kind of closed up. And now we've seen it, sort of start to come back, right? There was an issuance by Goldman and Citi that was a true conduit deal. Deutsche Bank, Mark can talk a little bit about the IG2 deals, which are a little bit different, but, certainly a great sign. We announced a deal yesterday with 3 other issuers to bring a traditional conduit deal to market. The GC deal, priced at 145. So it seems like, spreads are sort of finding, some footing here, which would be a good thing. You won't, be able to confirm that until there's more issuance. But I think the big thing is, everything that's getting sold now is all loans that had been in inventory, originated sort of pre-COVID.
Right.
You can't really judge what, where the market is or if it's come back until you see some post-COVID originated pools get done. And I think that's,
sure,
that's not going to happen this summer. That's fall at best.
Yeah. So with that point, and maybe Mark or Chris, we both can kind of chime in, but just following up on that, new deals going forward, how long, how many deals, how much is left on book that was originated prior to the crisis before we're looking at new originations to put conduit deals out or new pools together?
I've heard 8 to 10 billion, Mark. I don't know if you've heard a similar number.
I mean, we started at about 2 and we're down to a little more than 1. So I don't know about the rest of the market though.
Yeah, through the MBA, I've sort of anecdotally heard, somewhere it was between 10 to 15 to start. And now I think, maybe around 10 billion. But look, the reality is there's a good chunk of that won't be sold, right? There are, let's just assume that 15 to 20% of that inventory is hotels. They're not going to get done.
Sure.
The deals that are coming to market now are what they're calling sanitized deals, right? So there's no hotel exposure, very, very limited retail. And so to get back to market with a combination of what we'll have left in inventory after what's saleable and new originations is probably going to take some creativity around, people teaming up and figuring out how to create new pools.
Sure. With that, being said, you kind of hit the nail on the head, having no hospitality in the Citi Goldman deal. I know all the bond classes were pretty much oversubscribed, but do you see an appetite? Is there pent-up demand for a pool? When do you think we might see something that has some strip retail in it, maybe some limited service hotel? How far off are we still a ways to go there?
Newly originated hotels, I would say, we are a bit of a ways off. As I said before about sort of it being uneven, I will tell you just from the stuff that we have closed on the books and, talking to existing sponsors, we've actually been pretty surprised about particularly the limited service hotels, how quickly the occupancy has bounced back. I think that obviously has a lot to do with, it's a lot easier for those guys to get back up and running. If you're not running a full service operation, you don't have to worry about getting a lot of the amenities back. If you're select service or limited service, it's a lot cheaper to open. So those are, locations where, if people aren't flying and they're driving, they'll pull into one of these places and stay. So we've seen that pick up a little bit quicker and that's a good sign, but it's still going to be, as we talked about before, difficult to underwrite these things with any sort of, historical bent.
How does the stuff that's on your books currently affect how you're pricing things today versus how you priced them 30, 60, 90 days ago?
It's less about pricing and just more about, inventory, right? I mean, it's not, and I'm sure Mark can speak to this as well, but, you're not going to go into your credit department and say, I want to book this hotel loan when you're sitting there with, a few $100 million of hotel loans that you haven't sold, right?
Yeah.
Why don't you sell those first before you make some new ones, right? I think that's so from it's not so much price discovery as inventory.
That's right. It's a credit issue.
So Matt, would you go into the market and do a CMBS loan today if you don't really have price discovery and you don't know where things are?
Look, we're certainly in the market looking for opportunities. I would say that they are far and few between. We're not seeing anything at a level that makes sense at this point. But if we found something, and I mentioned we closed a deal at the end of January in the CMBS world, that pricing was extremely tight. I'd be curious to see where pricing comes in. I can tell you the balance sheet guys and the bank lenders probably aren't going to do something unless it's, as rock solid can be. So I think CMBS is certainly a good option. I will say that, historically, the one thing that, the one aversion we've had to CMBS is dealing with servicers and special servicers when things go bad. That's always been the reason to go with the banks or the regional guys or your relationships on the balance sheet, because there's a phone you can pick up and call someone and get them on the phone in 2 seconds and work out an issue or talk about something. And it's much harder on the special servicing side, one. And then two, in the event things go bad, we've always had this thought that, the special servicers almost have something to gain to keep it in special servicing for a long time. And I know, Tammy, we touched on that a little bit before, but I'm curious to hear your thoughts on how that, has changed over time since 2008 and 2009 to today, and how the special services are controlled, set up, and how they will work with you.
Sure. First of all, don't give up on CMBS loans. I won't have a job, and there'll be a few other people on this panel
Me neither.
that might
A
go
few of us.
hungry. So please. Well, yeah. I mean, one of the myths that I guess I would like to touch on about special servicers, and there are things that folks out there listening have experienced for themselves. They are difficult to deal with. The process is arduous. It's long. Where we get someone in special servicing, a client, 12 months is an average to be in special servicing. So nothing happens fast. The servicers do, since CMBS 1.0, that was prior to the Great Recession, the borrower didn't have to pay the fee that they have to pay now in CMBS 2.0, which is that 2 basis points per month. So on a $10 million loan, you're dealing with $2,000 a month, or almost a quarter of a point for the year. That is the month, special servicing fee. It doesn't get collected monthly. It gets collected when there's a modification done at the end, but that is a real fee. Prior to 2.0, the master servicer paid that fee, but that's incumbent upon the borrower. And then the second fee incumbent upon the borrower is the exit fee. So if you strike a deal or some type of restructure or modification, anywhere from a half a point to a point is what you can expect to pay on exiting special service. Provided you strike a deal and you continue to be the ownership of the property. Obviously, if there's another alternative to that, then you're not going to pay anything. But it's important also to understand that one of the biggest differences from CMBS 1.0 to 2.0 and beyond, I'm just referring to CMBS 2.0 as anything not 1.0. So there's, up to CMBS 9 and 9X and et cetera. But the point is that they used to have a fair value option, the lenders. So they would be allowed to bid the fair value of the property if a property was in special servicing and pick up the property. And there was some egregious dealings on that front that ended not well for the borrower who owned that property, but it really pushed forward the visibility of that issue and that needing to go away, because borrowers were very uncomfortable with that because they felt like some of their properties were getting taken out from under them. That is not happening today. That in almost all the loan documents and PSAs is gone. So there's not a fair value option, so the lender can take it out from under you, which is a big fear. I think that folks that haven't been in special servicing, they're very nervous about that. So I think also you could think about the CREFC, which is a big organization, trade organization. They've been lobbying very, very hard for borrowers, CMBS borrowers, and making sure that the visibility for CMBS borrowers kind of not to get taken advantage of by servicers is in high relief. It's out there. So you can't steal something from a special servicer, but if you do take the right steps and you have a plan and you are communicative, transparent, and other things, present yourself the right way with the right narrative, we've been getting deals done, and we know we will continue to get deals done, but it is a long, enduring process. Hope that answers you.
Oh, it does. Look, I guess the follow-up to that is there any incentive to the special servicers to work with you and figure out something? Because it seems like they are collecting fees on a monthly basis, and these are drawn out processes. But
yes, but they don't. They make fees other ways as well. They make fees when they sell loans. They do make fees. It is that I would say the lights and plug money is that 2 basis points, right? And then the modification or fee at the end is heads more toward their P&L profit. But they have a fiduciary responsibility. If you believe that that's being honored, they have a fiduciary responsibility to take the highest net present value option. So if the borrower, if we can present the borrower as being the right person group to own the real estate, which is what our job is, then through the narrative and through financial modeling, they're obligated to highly consider that versus an exit, which could be, you know, one of their auction platforms. All the services have an different auction platforms, or taking it into REO. So theoretically, it's predicated upon their fiduciary responsibility to the trust and to the bondholders to get the best deal they can, including the borrower's deal. So
hey Tammy, one of the things that was inserted, you know, post-crisis to sort of try and put a limit on some of the shenanigans that we saw the first time was the insertion of an operating advisor. Have you had any experience as of yet with the operating advisor and whether their role is meaningful or not?
We have not run into the operating advisor too much, Chris. So we have really just been able to deal with the folks that we've been dealing with for the last 10 years. You know, we know all the heads of servicing. We haven't had to deal with shenanigans that we've seen. So we have not seen that be a highly influential role, but I know it makes people feel better to know that they're there.
Okay.
The word that we're hearing from the servicers is that the key word that keeps coming up is, you know, they're trying to establish true hardship.
Yeah.
So, you know, is that, you know, in the case of hotels, it's very easy to establish hardship, right? The government forced me to close my property.
Right.
But I think that Fitch is reporting that of the 5,000 borrowers that have reached out to their servicers, 75% of those are hotel, retail, and some multifamily. But yeah, I think that the key is like these properties, like how many of the borrowers have cashed out? Have they been, you know, is it as 2-to-1 debt service coverage? This year, they've probably taken more cash out of the property than they're asking for the servicer to forbear. So I think, you know, each case is different, but, yes, you know, and I'd say the vast majority of people have real need for forbearance, but there's also some instances of borrowers trying to take advantage of the opportunity to make a change to their loan at this moment in time.
Yeah, and I will just, to your point, Mark, that's not a good strategy. It's not going to fly. They're going to say no. I know CW's James Shevlin, we talk to these guys all the time. You know, they rejected about 30% of their requests for forbearance just because there were many cases that didn't qualify. If you qualify and you do the right things and you prepare, you're transparent, and you know, you're respectful in your manner of communication, doesn't mean you're going to get what you want every time. You're not, but there is a way to get things that make sense done. So I want people to understand that it's not the black hole that you may think it is.
Yeah, Tammy, that's great. And Chris, I know through your involvement in the MBA, you've been involved with some of the discussions with the Fed and their involvement in the market to try and help clean up some of this stuff. It seems like we're constantly in a battle with everything sort of being thrown on the property owners. You know, the tenants aren't paying rent, all these other things are happening, and yet they're expected to pay their mortgage payments. And I know the Fed's working on something, and you could just sort of give us an update from the MBA side.
Yeah, I appreciate it. We could spend an hour talking about the government's response to the crisis, but I'll try and just concentrate on, you know, what's been focused with respect to CMBS and sort of real estate. I appreciate the opportunity to, you know, give a little bit of a shameless plug for the MBA, but they have really been focused on this since the beginning. Way back in March, we worked, you know, Tammy mentioned CREFC. They've been obviously one of the strong advocates. There's a lot of trades in DC that coordinated Back on the 24th of March, we, issued a joint trade letter in support of, we issued it to the Fed, to the Treasury, the New York Fed, and the FHFA, advocating for CMBS inclusion in TALF. There were daily conversations with the Fed leading up to, a follow-up letter being sent in early April by a bipartisan committee in Congress, also advocating for it. And then in early April on the 9th, AAA CMBS agency was included in TALF. Now that was a little bit of a disappointment that it was only the agency AAA and not CMBS, but I think it had the intended effect. In March, AAA CMBS in the secondary market blew out to 300 over. And then, when the agencies were included in TALF, CMBS is going to trade in relative value to where AAA agencies are. So you saw those spreads immediately come back in sort of to the, below 200. So it did have the intended effect, although they weren't, actively buying CMBS, new issue or any CMBS, traditional CMBS. It was all agency. It did have the effect on spread. So, through April, we continued to lobby to get actual CMBS included in TALF. There was an additional letter, a joint trade letter sent to the Fed at the end of March to include new issue AAA CMBS, single asset, single borrower deals, and CRE CLOs. CREFC's been heavily involved. The MBA has been involved. There's still daily talks going on. I can tell you that it's more than likely that within the next month, that will happen. I don't think it will happen for CRE CLOs, but it will happen for CMBS and for SASBs, single asset, single borrower deals, which would be good. That's kind of the way it happened, during the great financial crisis. It was added later, so I think there's precedent for it. So I think that's what you'll see. The other thing that's been going on with the trades, they've been working, hand in hand with, the tenant organizations, particularly the hotel trades and the retail trades. And they have been, in discussions with the Fed around what can be done with respect to sort of relief efforts. I can't tell you that anybody's got a good answer because it's a complicated question with respect to, the way CMBS are issued and the regulatory and legal issues that pertain to the trusts, but it is being paid attention to. I think, Bryan, you might have mentioned it at the top when, Chairman Powell was testifying this week in front of Congress. He was asked by senators specifically about CMBS. I don't think, in my 30 years of doing this, I've ever heard that come out of a Senate hearing. So it was encouraging. It's being paid attention to at the highest levels. And like I said, I don't have the answer or can promise you, what's going to come of it. But the fact that it's even on the table, I think is a good sign.
Yeah. And Chris, with regards to, kind of the open purchases from the Fed and all of the help that we're seeing there, you touched on the difficulties of the way that, the trusts are structured for providing relief, but do you see the possibility of going any further down the bond classes, away from AAAs? Because it seems to me that's where we really need, some help to get the market rolling again. The more IG tranches are seemingly trading, at volumes that are relatively healthy. And, if there was something closer to the lower rated positions, it might be, helpful to the overall industry.
Yeah, listen, I think it's all relative value, right? You mentioned, lower down in the stack. So the numbers I talked about before with respect to AAA, where, they blew out to sort of 300, when the crisis first hit, triple Bs were over 1,000, right? The triple Bs got done in the GC deal in, 525 area, right? So I think, you've seen that naturally come in. And I think what the expectation is, again, CMBS will draft off of other, fixed income products. So if they provide relief to corporates down in credit, which they have, then the relative value of CMBS, if corporates are trading, 500-600 basis points tighter, the market's not going to stay there. That'll naturally come in, because the good thing about, I think Mark might have touched on it before, the deals that have come out have all been oversubscribed. There is capital out there, and, the stuff that's being issued now, if you think about the risk return, equation, what you can buy now compared to what you were buying in January, you're getting much better spreads. You're getting, collateral that's, the pools are much cleaner, lower leverage, sanitized, as I said before. So the risk return trade-off is really, really good. And so there's plenty of capital out there to buy. So that's, I think, what, from a federal response, you'd rather see, the market sort of correct itself. And if relative values on the corporate side, continue to come in, they'll naturally drag CMBS in.
And Chris, I would add that the Fed's inclusion of junk corporates should help those
That's right.
classes. Yeah. Like
Yeah,
you said,
I just wanted,
Go ahead, Tammy.
oh yeah, I just wanted to make sure that it was clear that the TAL has included the CMBS legacy.
That's right.
No, that's great.
Yeah, we're talking new issue, Tammy. That's right.
Right. And just a distinction for folks that, would love to have the new issue in there. I'd love to have the CLO, but we got something.
Mark and Chris, are any of these new policies that we're either anticipating or have come out, do you see those affecting the new originations in any way, where deals will be structured at all differently? Maybe, Fannie and Freddie were talking about having some level of an interest reserve on new deals. I would see CMBS do that.
I think CMBS is following suit there for the most part. It is deal specific. There are some, if I see a low leverage, very low leverage deal, do we necessarily have to have an interest reserve? It depends on, the profile of the transaction. But by and large, I would say CMBS is trying to implement those shorter term interest reserve structures, just because there's still a lot of uncertainty, right, around what could happen in the fall. Nobody wants to make a loan that's going to go delinquent, 30, 60, 90 days after you close. So some interim period, I've seen anywhere from 3 to 18 months, quite honestly. And it's really, I don't think it's much of a hardship. We're using it to pay debt service anyway, right? It's money that you would have spent. So I think it protects both borrower and lender, that structure in the near term.
Mark, are you seeing anything?
Concur. With the exception of like very strong credits or low leverage, very low leverage.
Right.
No, and that's interesting. I think I've closed 3 or 4 loans, and we've got 5 closing this month, and all of them have had interest reserves, everything from banks, credit unions to insurance companies. It seems like nobody in Fannie and Freddie, we've got a Fannie and Freddie one closing today, that there's a 12-month reserve. So it seems across the board. Well, we're getting close to the end of our time. So what I wanted to do is give everybody a chance just to say a few words post-closing as we end to everybody out there. What do you think the key thing is, the takeaway maybe that people should think about? And also on new CMBS, where is it pricing for the 2 originators? What's the deal somebody could get today if they do the CMBS? Why don't we start with you, Chris?
Yeah, sure. In terms of, we're quoting deals. We've been quoting deals for the last 2 or 3 weeks. I would say coupons are probably in the low to mid 4s. Given where deals are currently pricing, you're probably getting a little less leverage and a little less IO than you got pre-COVID. But, that's for, office, select retail, industrial, multifamily. We're seeing a lot of self-storage. We're seeing a lot of mobile home parks. So that's been, I think the flavor. In terms of, going forward, final thought, I think so much depends on the consumer, right? We all know that our economy is largely driven by consumer spending. About 70% of GDP is consumer spending, and that has a lot of impacts, whether we're traveling, whether we're spending money, going out to restaurants. All these things, depend largely on consumer behavior. And I don't think we really fully understand yet, what that's going to look like going into the next 12 months. There's certainly some things that are being implemented now that are going to stick, some that aren't, but I don't have a crystal ball to know what those are yet. So I think we're all going to be sort of playing a little bit of defense and trying to evaluate what those are.
Mark.
Yeah, I agree with Chris on that. It's going to be interesting to see what the future holds. I don't know if there's going to be less demand for office space in CBD, high-rise multi-tenant buildings, but there's going to be increased demand for low-rise single-tenant buildings in the burbs that don't rely so heavily on public transportation. Just like we're going to be watching the consumers on the shopping centers and how they go back, it's going to be interesting to see what corporations do as far as where they choose to locate their offices and if they're going to allow employees to continue to work at home. I think some of that will stick. I think some percentage of companies are going to get comfortable with having some percentage of their employees work from home. But the landscape's going to change, and I think that at this call, CMBS, non-recourse financing, there's great value to that, and I think that the product will continue to provide liquidity for commercial real estate. We're just going to have to wait and see what these shifts and changes bring to us, and learn to underwrite these properties.
Matt, what's your takeaway?
Look, I think we are definitely still in the market looking for select opportunities. I think the longer this goes on, the more difficult it is to underwrite these deals and project something forward. I think tenant credit and stability is a huge factor going forward for us. And frankly, I think there is going to be a shift somewhat, at least in the near term, to suburban single-story office, two-story office, and then garden-style apartment living. I think people really have an aversion from getting in an elevator in the middle of Manhattan with 5, 10, 15 other people. But look, we hope this thing ends soon. Again, the longer it goes on, the more difficult this is. And we'll continue to utilize CMBS for our new deals, especially in markets where the banks are not necessarily willing or able to go, and where we think that there's opportunity, and value to be created.
Tammy, what's your view? And I also want to add and that we've got multiple questions. I don't know if we're going to have time for all of them, but most of them have been around special servicing and how do you deal with the CMBS lender. So as you do your response, if you could add a little bit of that as well.
Sure. I guess, going forward, I think the panelists did such a great job that I'm going to talk about. My takeaway would be working on what we have right in front of us now, and folks that are experiencing setbacks, cash flow setbacks. A lot of very nervous borrowers we're talking to, and I would like to say to them that there's a path. There is a path, and to kind of extend the olive branch between the borrower and the servicer. But I would like everyone to kind of understand that just the way the REMIC, which is the legal entity that the pools are in, when you start with, there's some inflexibility in the REMICs. There's inflexibility in the purchase in the PSAs that govern these loans. So therefore, there's inflexibility on many things with the servicers themselves. There's things that they can do. There are things that they can't do. Probably could they do more than they're going to do? Yeah, we always think they could do more. But I think it's important to know, I don't feel that they're trying to take advantage of borrowers in the situation. I don't think their end game is to build up a whole stack of properties and try to run those better, in particularly hotels, right? Because who operates a hotel unless it's a very lagging property due to management? Who's going to operate an operating business better than the operator? I mean, a lender, that's not a forte. We all know when receivers end up going in, from our experience, that potential lessors are very hesitant to sign on. So I don't think it's their end game to accrue a lot of REO. I think they'll take the deals that are subpar, not performing, and if the borrower doesn't have anything to bring to the table, right? You have to bring something to the table. So I would say to a borrower, one of the things they need to think about is, and this was alluded to previously, if you just cashed out and you're asking for relief, in April or May, that may be frowned upon if you recently cashed out on a refi. Just think about it from the lender's vantage point in that, you're the equity, they're the debt. So you have to be willing to come to the table with something. If you don't have the cash and at some point you decide with your group and team that it's not sustainable or feasible to continue to pay the debt service, then, when you do go into special servicing, I think reasonable, well-supported, documented requests get the most traction. If you're submitting things that are not realistic, unachievable, and who knows what that looks like, because most people haven't been in special servicing. We have a lot of experience doing that, but there are ways to do it and get heard and to do it the right way. So I think there's hope in that regard, and we have to clean up kind of the mess we're in first.
Tammy, would you say be proactive,
I
in
would.
advance, or would you say wait till something happens?
If I'm going to pay my loan, if I'm planning on making my payments every month, I may consider paying. I may have paid April, I may pay May, and then I'm going to look to the next 3 or 4 months and say, what's the how realistic is it to pay these next few months? If I don't think I can pay for the next 3 months, I may start to think about as a borrower, well, do I want to preserve that cash? Do I want to preserve that cash for down the road when a modification gets done and I need to pay a point, I have some legal fees, I have other costs. But be proactive. If you're not going to meet your requirements with the lender, be proactive and setting your story straight with them and communicate that. But don't go looking for trouble on the other hand.
Yeah, to Tammy's point there, you're negotiating from a point of, from a point of being a good guy, right? Everybody knew there was problems in March and April. If you made your payments in March, April, and May, and then you come to them, to ask for relief, that's a much better story.
Agree.
That's great, and that's great advice. Jarod, anything to add real quickly before we end?
Yeah, look, I think that whether you're looking to, some need for a modification down the road, or you're staring at a bullet and you're going to need to refinance, CMBS originators, buyers, rating agencies, they all love data. So I would just, urge everyone to be working with a team that can help you in that regard, and be keeping track of, your leasing momentum, be keeping track of, be talking to your tenants, getting sales figures. I can't tell you how many times that, you would get asked for that, and you're like, well, we don't have that. We don't know. And not knowing is sometimes worse than knowing a bad answer if you can quantify it. So I would just encourage everybody to be working with a team, that can help you through the process. All of the panelists on the call today, have the track records and the experience, and be keeping track of that data, because I never have heard someone say there's too much data here. It's always more is better. So
the lifeblood of the CMBS industry.
Yeah.
No, well, thank you, everybody. On behalf of George Smith Partners, I want to thank our audience. And I want to thank you guys as the panelists. As Jarod said, I think we had a winning team of panelists today, and you guys gave some great information. And anybody that has any further questions, reach out to us and we'll forward the questions directly to them. So thanks, everybody, so much for taking part.
Thanks, guys.
Enjoyed
it.
Thank you.
Likewise. Thanks, everybody. Bye.
Thank you.